Banks don't want you to understand this. Let me ask you something that might sound a little paranoid at first. Have you ever noticed that nobody at your bank, not the teller, not the app, not the website, not the guy who called you to check in on your financial goals, has ever once sat you down and explained exactly how they make money off of you? Not vaguely, not in fine print buried on page 11 of a terms and conditions document. Nobody reads. Actually explained it, clearly, in plain language, like they were on your side, because they're not on your side. And I don't mean that in a dramatic conspiracy theory kind of way. I mean it in a very simple, very boring, very obvious business sense. Banks are businesses, enormously profitable businesses. And the way they stay enormously profitable is by making sure the average customer never fully understands the mechanics of the relationship. Because here's the thing. The moment you understand how banks actually work, how they use your money, how they profit from your habits, what the numbers actually look like on their side of the ledger, you start making completely different decisions. You stop leaving money in the wrong places. You stop paying for things you didn't realize you were paying for. You start using the system the way wealthy people use it instead of the way the bank designed you to use it. My name is Jack, and I'll be honest, the mechanics of banking and how financial institutions profit from ordinary people's money is one of those topics I find genuinely fascinating and a little bit infuriating at the same time. Because the information isn't hidden, it's all technically out there. Banks aren't doing anything illegal, but the way it's structured, the way it's presented, the way the whole system is designed, it consistently benefits the bank and consistently costs the average customer in ways they never see coming. So today we're pulling back the curtain. All of it. By the end of this video, you're going to understand exactly how banks make money, where your money actually goes when you deposit it, and most importantly, what you can do differently starting today to make sure the system works for you instead of against you. Let's get into it. 1. The basic trick. Your money is not just sitting there. Okay, let's start with the most fundamental thing most people don't fully understand about banking. And it's something so basic, so foundational, that once you see it, you'll wonder why nobody explained it clearly a long time ago. When you deposit money into a bank account, that money does not sit in a vault somewhere with your name on it. It doesn't stay still. It doesn't wait patiently for you to come back and get it. The moment your deposit hits the bank's books, they start putting it to work. Here's how it works. Banks operate under what's called a fractional reserve system. This means they're required to keep only a fraction of deposits on hand as reserves. The rest they're free to lend out. And lend out is where the profit engine lives. Think about it this way. You deposit $10,000 into your checking account. The bank keeps maybe $1,000 in reserve, just in case you need to make a withdrawal. And lends the other $9,000 to someone else as a car loan, a personal loan, a mortgage, a business line of credit. That borrower pays the bank interest. Let's say 7 or 8% on a car loan. The bank collects that interest every month. Meanwhile, what are they paying you for the privilege of using your $10,000? If you're in a traditional savings account at a major bank right now, probably somewhere around 0.01 to 0.5%. On $10,000, that's $1 to $50 a year. They're earning 7 or 8% on your money. They're paying you 0.01%. The spread between what they earn and what they pay you is called the net interest margin, and it is the core profit engine of every traditional bank in existence. This isn't a scandal, it's just how banking works. But understanding it changes how you think about where you keep your money, because that 0.01% savings account isn't a favor the bank is doing you, it's the bank keeping almost all of the return your money generates and handing you a rounding error in exchange. 2. The fee machine. How banks profit from your daily habits. The interest spread is the big engine, but banks have built an entire second profit machine on top of it, one that runs on fees. Small, seemingly minor, easy-to-miss fees that add up to billions of dollars in revenue every single year. Let's walk through the main ones because I want you to really see these clearly. Overdraft fees. This one is almost predatory in its design. You accidentally spend $2 more than you have in your account. Maybe a small automatic payment clears at the wrong time. Maybe you miscounted. And the bank charges you $35 for a $2 overage. The fee is 17 times the amount of the problem it's ostensibly solving, and banks collect roughly $7 to $8 billion in overdraft fees across the industry every single year, not from wealthy customers with large balances, overwhelmingly from people living paycheck to paycheck who can least afford a $35 surprise. Monthly maintenance fees. A lot of checking accounts charge $12 to $15 a month just to exist, unless you maintain a minimum balance or meet some other condition. $12 a month is $144 a year. For a checking account, that's $144 a year for the privilege of letting the bank use your money to make loans at 7%. ATM fees. Use an out-of-network ATM and you might pay $3 to $5 to the ATM owner and another $2 to $3 from your own bank. $5 to $8 to access your own money for 30 seconds of inconvenience. Wire transfer fees. $25 to $35 to move your own money from one place to another electronically, something that costs the bank a fraction of a cent to execute. Foreign transaction fees. Typically 1 to 3% on every purchase made abroad or in a foreign currency. Travel internationally for 2 weeks and spend $3,000? That's up to $90 in fees you might not even notice because they're baked into the exchange rate. None of these fees are hidden in the sense that they're secret. They're in the terms. But they're designed to be easy to ignore, small enough individually that most people just absorb them as a cost of life, rather than a specific, avoidable charge that's making the bank significantly richer at their expense. 3. The savings account illusion. The biggest quiet theft in personal finance. Okay, this one genuinely bothers me, because it affects almost everyone and almost nobody talks about it in a direct, clear way. The traditional savings account at a major bank is one of the worst places you can keep money. And yet it's where most Americans park their cash savings, money. Because it feels safe, it's familiar, and the bank certainly isn't going to call you up and suggest you put it somewhere better. Here's the math that makes this real. The average traditional savings account at a major bank right now is paying somewhere between 0.01% and 0.5% annual interest. Meanwhile, high-yield savings accounts, offered by online banks and credit unions, are currently paying somewhere between 4% and 5%. Same FDIC insurance, same accessibility, same liquidity. Just dramatically higher returns because online banks have lower overhead and actually compete for your deposits. On $20,000 in savings, the difference looks like this. Traditional bank at 0.5%, you earn $100 a year. High-yield savings at 4.5%, you earn $900 a year. That's $800 a year in additional interest income you're leaving on the table for absolutely no reason. Over 5 years, assuming rates stay roughly similar, that's $4,000 in missed earnings. Just from having the wrong type of account. And that's just on $20,000. If you've got $50,000 in a traditional savings account, you're missing roughly $2,000 to $2,250 a year. Every year. For doing nothing differently except where you keep the money. The reason most people don't make this switch isn't that they're unaware high-yield accounts exist. It's inertia. The existing account is already set up. Direct deposits are already running through it. It feels like a hassle to move things. And the bank is counting on exactly that inertia, designing their experience to make staying easy and leaving feel complicated. The fix takes about 20 minutes to execute and pays you hundreds or thousands of dollars every single year in exchange for doing it. 4. Credit cards, the most profitable product banks ever built. Let's talk about credit cards, because they are, without question, the most sophisticated, most profitable, most psychologically engineered financial product in the history of modern banking. And most people who use them have no idea how precisely the machine is designed to extract money from their behavior. The basic mechanic is well known. You spend on the card, you carry a balance, you pay interest. Average credit card interest rate in 2026 is sitting somewhere around 20 to 24% APR. On a $5,000 balance, that's $1,000 to $1,200 in interest per year. Just on $5,000. But the part that's less talked about is how the minimum payment structure is specifically designed to maximize the interest you pay over time. If you have a $5,000 balance at 22% interest, and you make only the minimum payment every month, which is typically around 2% of the balance, it takes you roughly 25 years to pay it off. And you pay approximately $8,000 in interest on top of the original $5,000 balance. You paid $13,000 total for $5,000 worth of stuff. That's not an accident at the math. That's intentional product design. And then there's the rewards trap. Banks spend heavily marketing the points, the cashback, the miles, the perks, and these rewards are real. If you pay your balance in full every month, rewards cards genuinely do give you something for nothing. But here's what the data consistently shows. The presence of rewards causes people to spend more, significantly more. Studies suggest rewards card users spend 12 to 18% more than cash users on equivalent purchases. The rewards you earn back are typically 1 to 2% of spending. The bank is getting 12 to 18% more spending out of you in exchange for giving you back 1 to 2%. That's an extraordinarily favorable trade for the bank. Used correctly, paid in full every month, never carrying a balance, a credit card is a free short-term loan with rewards on top. That's genuinely a good deal. But the bank isn't designing the product for the people who use it correctly. They're designing it for the majority who don't quite manage to. And that majority is subsidizing the rewards for everyone else. The mortgage game. Where the real money lives. Hey, quick genuine pause. If this is the kind of content that makes you feel like someone is finally explaining how this stuff actually works, please hit subscribe. It takes literally 2 seconds, and it means the channel can keep making videos exactly like this one. I appreciate it more than you know. Hit subscribe. And let's keep going because the mortgage section is honestly one of the most important pieces of this whole conversation. The mortgage, the single largest financial transaction most people ever make. And the structure of it is specifically designed so that the bank makes the majority of its profit before you've barely started paying down what you actually borrowed. Here's how amortization works. And I want to explain this simply because I think it's one of those things where seeing it clearly changes how you think about homeownership fundamentally. When you get a 30-year mortgage, your monthly payment is fixed. Same amount every month for 360 months. Feels straightforward, but what that payment is actually made up of, the split between principal and interest, changes dramatically over time. In the early years of a 30-year mortgage, the overwhelming majority of every payment goes to interest. Take a $400,000 mortgage at 6.5%. Monthly payment is roughly $2,528. In month 1, $2,167 of that goes to interest. Only $361 goes to actually paying down the loan balance. Month 1, you paid $2,528, and your loan got $361 smaller. By the time you reach year 15 at the halfway point, you've made 180 payments, paid roughly $455,000 in total, and your remaining loan balance is still around $285,000. You're halfway through the loan in time. You're barely a third of the way through in actual balance reduction. This is called front-loaded amortization, and it means the bank collects the vast majority of its interest profit in the early years of the loan, specifically the years when people are most likely to refinance or sell and start the clock over again. Every time you refinance, you reset back to month 1 of the amortization schedule. More interest-heavy payments. The bank wins again. This isn't illegal or even unethical. It's just how loan math works under compound interest. But understanding it has practical implications. Making even 1 or 2 extra principal payments per year, directly toward the balance, not toward interest, can shave years off a 30-year mortgage and save tens of thousands in total interest paid. Extra principal payments hit differently at year 2 than at year 28 because they eliminate future compounded interest before it accumulates. What wealthy people do differently with banks. Okay, so we've established how banks make money, the interest spread, the fees, the credit card design, the mortgage structure, all of it. Now let's flip it, because wealthy people have a fundamentally different relationship with banks than the average customer. And the difference isn't just that they have more money, it's that they understand the mechanics well enough to use the bank instead of being used by it. Here's what that looks like in practice. They don't keep significant cash in traditional bank accounts. Wealthy people keep their operating cash, the money they actually need for transactions, in checking. Their savings go into high-yield accounts, money market funds, or short-duration treasury bills through platforms like Treasury Direct or a brokerage. They are not letting $50,000 or $100,000 sit in a traditional savings account earning 0.2%, while the bank lends it out at 7%. They pay credit card balances in full, every month, without exception. They collect the rewards, the travel benefits, the purchase protections, and they never pay a dollar of interest. They use the card like a debit card that happens to come with perks and a 30-day float. The credit card is a tool, not a lender. They understand the mortgage amortization schedule and make strategic extra payments. They know which payments actually move the needle on principal versus which ones are mostly interest. They time refinancing decisions carefully rather than reflexively refinancing every time rates drop a quarter point and resetting the amortization clock unnecessarily. They negotiate. This is something that shocks a lot of average bank customers. Fees are often negotiable, especially for customers with significant balances or long relationships. Annual fees waived. Overdraft fees reversed. Better rates on savings. A phone call asking politely is worth more than most people realize. Banks want to keep profitable customers. Asking costs nothing. They use banks for what banks are actually good at: transaction infrastructure and credit access, without leaning on them for wealth building. Your bank is good at moving money around and lending you money at a price. It is not a good investment vehicle. The moment you treat a bank account as the place where wealth is built, rather than just the place where operating cash lives, you're letting the bank win the whole game. 7. The alternatives. Where your money should actually live, all right. So, if the traditional bank isn't the right home for your money beyond transaction cash, where should it actually go? Let's be specific. Your emergency fund, 3 to 6 months of expenses, goes into a high-yield savings account. Not a traditional bank savings account. An online high-yield account through a bank like Marcus, Ally, SoFi, or a credit union. Currently paying 4 to 5%. FDIC insured. Accessible within 1 to 2 business days. There is no meaningful downside to this switch, and it pays you hundreds to thousands of dollars more per year for doing nothing differently. Beyond the emergency fund, money you want to grow goes into investment accounts. Roth IRA, 401k, taxable brokerage, broad index funds. This is where real wealth building happens. Not in a savings account, not in a CD, not in whatever financial product your bank's wealth management arm is trying to sell you. Short-term savings for specific goals, a house down payment in 2 years, a car in 18 months, goes into high-yield savings or short-term treasury bills. Currently yielding around 4.5 to 5%. Safe. Liquid enough for your timeline. Better than any traditional bank savings product. For credit, use it strategically and pay it off. 1 or 2 rewards cards that align with your actual spending categories. Balance paid in full every month. Let the rewards accumulate without letting the interest machine turn on. The bank gets your transaction account. Your paycheck flows through it, bills come out of it, your debit card works off of it. That's it. Everything beyond operating cash goes somewhere that's actually working for you, not working for the bank. 8. The mindset shift that changes everything. Here's the thing I want to leave you with before we bring this home. Most people have a fundamentally passive relationship with their bank. They picked an account years ago. Maybe because it was convenient. Maybe because it was the bank their parents used. Maybe because there was a branch near campus. And they've just stayed there. The money goes in, the bills go out, and the bank quietly does its thing in the background. And that passivity, that inertia, is worth billions of dollars to the banking industry every single year. It's the product. Your inertia is one of the most valuable assets a traditional bank has. The shift that changes everything is moving from passive to intentional. Not paranoid, not anti-bank. Banks provide genuinely useful services and you do need one. But intentional. Asking at each stage of your financial life, is this the best structure for my money? Or is this just the default I never questioned? Is this savings account paying me a competitive rate, or am I just here because I never moved? Am I carrying a credit card balance, or am I using the card as a tool and paying it off? Do I understand what my mortgage payment actually covers each month, or am I just watching the calendar tick? Am I using the bank for transactions and credit while letting my actual wealth build in better vehicles? These aren't complicated questions. They don't require a finance degree. They just require the willingness to actually ask them and to act on what the answers tell you. The bank will never ask these questions for you. That's the whole point. But now you know to ask them yourself. Conclusion. The most powerful thing you can do after watching this. Let's land this. Banks are not your enemy. They're a service you use, but they are a business. A very well-designed, very profitable business. And the way they stay profitable is by counting on you to not fully understand the mechanics. The interest spread between what they earn on your deposits and what they pay you. The fee architecture built around your daily habits. The savings account that sounds safe and quietly loses you. Subscribe to support, please.